Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, again, another podcast.
Always another podcast, Andrew. One after the other, after the other, after the other.
Indefinitely.
After the other. Absolutely. So now back in the recording studio, we'll call it, for another enthralling installment of a particularly hot topic, maybe.
Yep. Look, I think it's a topic of conversation with almost all of our clients, whether it's something that people have considered or not outside of when they go through the financial advice process, I don't know, but definitely a point of conversation for us and the vast majority of our clients.
And throwing back to last week's episode as well too, this one will tie into cash flow a little bit as well. It'll make more sense. Andrew, tell us, what are we talking about today?
Yeah, so today what we're doing is we're comparing and contrasting life insurance policies. And when I say life insurance policies, we're talking life, permanent disability, and income protection. We're not talking about trauma insurance here, even though that is technically one of those policies. It doesn't form part of the conversation because what we're talking about today is difference between holding these policies inside of superannuation and outside of superannuation. Now, trauma insurance can't be funded through superannuation, has to be paid for out of pocket, so there isn't even a discussion point there. Kind of either pay for it out of your own pocket or don't have the cover. Whereas the life, the permanent disability, the income protection, we're looking at the differences between funding mechanisms and ownership structures for those two policies.
Yep. And also doing a bit of a dive into policy definitions and what's the difference between the two from that perspective as well. So
yeah, exactly right.
First one, pretty straightforward. Impact on cash flow. Sort of throw back to last week's episode about increasing interest rates. One of the big major differences holding insurances inside super versus outside, pretty straightforward. You don't have to fund it. It's inside super. You don't have to fund it from your own personal cash flow. You're still paying for it with your own money.
Just future money.
It's just future money because you can't actually access your superannuation until you meet a condition of release. For the sake of this exercise, we'll assume that it's just money that you can't touch for a long period of time. But that seems to be, I guess, a starting point for the conversations that we have with clients around, okay, which way do we go when we make a recommendation? Is it inside super? Is it outside super? That's probably the first starting point is around the cash flow, because we know that housing it inside super and not needing to find hundreds of dollars per month or whatever the premium is inside your budget to be able to pay for these insurance policies. A lot of the time it's fairly attractive to hold it inside superannuation.
Yeah, exactly. I mean, look, I would argue that if you're holding a policy inside of superannuation, you should be at least salary sacrificing to cover all or part of the premium cost. And so really should impact your cash flow to some degree, depending on what it is. But if it's funded via superannuation, you're not physically impacting your cash flow. And if that is what you're doing, so if there's some uncertainty around cash flow, one of the strategies that you can use is you fund the policy inside of superannuation and you salary sacrifice towards superannuation in order to pay for the premiums. Now, what that means is under ordinary circumstances, if that policy is held outside of superannuation, you have to pay for the cost of it outside of superannuation. But if you've got a change in your cash flow, if you've got a change in, you take on an additional mortgage, you have the ability to dial your salary sacrifice up and down, and you may decide the initial stages to fully fund the cost of the insurance policy via salary sacrifice. And then as things change and as your circumstances change, to only partially fund it via salary sacrifice. So it does give an element of flexibility associated with the cost of insurance as well.
Yeah, and I really like that one as well too, Andrew. And it's one that I tend to get a little bit of, I wouldn't say resistance about, but you don't get anything for free. And what I mean by that is if you take out your insurances inside your super, it's going to have an impact on your superannuation, but you are getting peace of mind of having insurance cover. So assuming that you're getting something and you need to pay for something, then that conversation around we should salary sacrifice as opposed to just saying, you know what, my super fund can handle it. I'm not too fast. I can't touch the money for umpteen years. there should be a conversation piece and a consideration to, hey, I am getting something in return. I should pay for it. And if it is inside super, it is concessional contributions to offset that. That's the theoretical part. Whether that actually happens in practice is a different story, because no one likes paying for anything and increasing their costs, right? So that's pretty fair enough.
Yeah, exactly.
Yep.
And look, I guess one of the other benefits of holding cover inside of superannuation, and in particular what we're talking about is life and permanent disability, is the cost, so the premiums associated with life insurance and permanent disability. Pay for it through superannuation. Cost of insurance is tax deductible. Now it's tax deductible at the concessional rate of superannuation, so it's tax deductible at 15% of the super fund, as opposed to you pay that outside of superannuation, you don't get a cost deduction associated with life insurance and permanent disability. So the tax deductibility associated is another benefit of holding, in particular, those two insurances inside of superannuation as opposed to outside of superannuation.
Yep. One of the other things I like, and is a benefit and an advantage of holding insurances inside super as well too, is yes, it does have an impact on your superannuation balance because it has to fund it. However, it's being funded from an investment vehicle. So in the event that your super is performing and it's doing what it needs to do, then you're paying for premiums with investment money, with an asset that's designed to create a rate of return, as opposed to paying for it out of pocket, where you're just trying to keep up with all of the pressures of cost of living with your regular income coming in. So that's one of the things that I always tend to think is quite beneficial when we're looking at housing insurances inside super as well.
Yeah, absolutely. Default covers, that's another one. Tell us a bit about that, Bills.
Yeah, so depending on what type of policy you're getting and how you're getting it, a lot of the superannuation funds, which leads to housing insurance inside super, a lot of the bigger funds, and especially around like corporate funds and things like that, they will offer default cover to members joining the fund. So one of the main advantages of that is that you can get the insurance cover that's available within that fund, but you don't need to go through the underwriting process. So I guess there's two real benefits to that, and there is a disadvantage to it as well, which we'll cover when we start talking about the disadvantages. But the real benefit to that is one from a convenience perspective, because going through underwriting is... We're on a podcast,
Sorry,
so I can't really say too much. But look, it's an inconvenience. You do go through a whole heap of medical questionnaires, depending on the level of cover. You can go through medical tests as well too, depending on your medical history. It can get more onerous if you've had things wrong or if you are suffering from any particular conditions. So you sidestep all of that. So that's one of the benefits. It's just the convenience from that perspective, which we find that works with some of the superannuation funds, that is quite beneficial from that perspective with your default cover. The other thing too is that it's automatic. You just get it. It's done. It's over. It's quick. Away you go. You've got it.
I mean, you do need to be sort of careful with default covers, and you need to be careful about how you're going about it and making sure that you're not just taking default covers with a whole range of insurers. But there's obviously some knowledge that needs to go behind it to make sure that you're going to get paid out if you are actually in the event of a claim. However, it does offer the advantage of, if there's a pre-existing condition that prohibits you from being able to get insurance cover, that is an option. So that's one of the options that otherwise wouldn't be available outside of superannuation. If you're applying for a policy outside of super, there's no default cover, there's no option for having some form of basic cover that's going to cover at least something. When you're having that cover within default providers or employers that offer that benefit, if you're not able to get insurance due to medical pre-assessment or hazardous occupations and whatnot, it's an avenue to be able to get some form of insurance cover that otherwise wouldn't be available.
Yeah, and that's a really significant consideration if you're in that category. And sometimes that's a strategy that we work on all of the time, because at the very least, you want to try and get the cover that's available for you. And if you can't, because of your history or what have you, this is kind of like the best option available, because you can't really get it anywhere else.
Yeah, so, and they don't make it easy for you, I tell you.
Yeah, yeah.
It's not an easy process to go through when you're going through medical underwriting for insurance policies.
100%. Andrew, let's talk about some of the disadvantages of housing insurances with inside super. I guess from a taxation perspective, that's probably the first port of call.
Yeah. When you're paying for, or when you get paid out for insurances, now when we're talking about life insurance and permanent disability, In the event of a payout of either one of those two covers, depending on your circumstances as well as your beneficiary's circumstances, if the policy is paid for through superannuation, then there may be a tax associated with the benefit amount in the event of a payout. So what that means and what should be done in this instance is if you're paying for insurance premiums inside of superannuation, life insurance and permanent disability, one of the considerations is potentially applying for an increased level of cover to account for the fact that there may be some tax associated with that benefit amount. Now, again, you're increasing the level of cover, so you need to pay for that increase as well and take all of that into account when putting it into the blender and looking at the fact of, yes, it's tax deductible, I get a discount because I'm not paying tax, but in the event of a payout, I'm paying more tax, so I need more cover to pay out that benefit amount. So putting all of that together sort of helps ascertain the benefit for a client as to inside versus outside of superannuation for those policies.
Yeah, can't be overlooked, especially when you sort of go a little bit further down the track and you're looking at beneficiaries. And if there's issues with estate planning and estate equalisation, you can create some issues if you think that the estate's going to be worth X and it comes out as Y because there's a tax liability there as well. We've done podcasts before about taxation with inside superannuation, so that's just another consideration when it comes to that as well. Disadvantage from my end, probably the main one's the premium impact. The premium is going to be eating away at your retirement savings vehicle, kind of throwing back to what we were talking about before, offsetting that with a concessional contribution, but it is a consideration because not only is it having an impact, but you've got to look at the impact over time as well too, because naturally, as we get older, with insurance, actually with everything gets more expensive. With insurance in particular, the older you get, this is a gross generalization, but the older you get, the more likely that you are going to make a claim on your insurances. So we tend to find that the older clients get, the more expensive the premiums get and are. And what that does do is it starts having a greater impact on the superannuation itself, because that's the vehicle that's funding the premium. So that's probably the main disadvantage from that perspective, but need to keep an eye on what that looks like year in, year out. If you're in a position to offset it with your cash flow and add some concessional contributions to it, that's always a great thing as well too.
And it's also, it starts to blur the line. Your superannuation is a vehicle for wealth creation, long-term wealth creation. Once you start funding insurances through it, it starts to blur the line between, yes, this is a vehicle for wealth creation, but at the same time, it's now a vehicle for me funding something for now. So you do need to have some discipline around if you are doing that and if you are funding it from superannuation, making sure that you're making those additional contributions, making sure that you're offsetting it so that the superannuation is still growing and doing what it's designed to do. One of the issues that I've experienced in the past is I've sat in front of a client and the whole agenda of the conversation is driving, they're in later stages in this particular scenario. We're trying to drive as much money towards superannuation in order to fund retirement. And the reason that we want to have it inside of the superannuation environment is so that we can take advantage of the fact that after the age of 65 or 60, if you're no longer working, there's no tax on the superannuation profits, essentially. So on one hand, you're wanting to maximize your wealth inside of superannuation in a tax-free environment. You're doing so by maximizing your contributions towards the superannuation fund. And then in the very same breath, you're funding insurances through superannuation that's pulling away from that goal and what we're heading towards. Having a really clear understanding of what you're trying to get to, what your overarching strategy is going to be, and what your goals and ambitions are for wealth creation, retirement, and fully fledged financial plan, and making informed decisions based on rationality, because it just doesn't make sense. And that's not a difficult thing to explain to somebody, but until you sort of start to look at it and think about it as something that set and forget a policy and start going down a different route in terms of wealth creation inside of superannuation, it can be really easy for that to slip away from you and for you to just continue making premiums paid for through superannuation.
Yeah, completely agree. And it's kind of, when you think about it, it's interesting because you're contributing money to super for a better tomorrow for your future self. And then you've got the ability to pay insurance premiums inside super which then take away from your future self for the benefit of today, touch wood, in the event that something goes wrong. So it's kind of like getting this balancing act right between creating wealth for your future self or using the same vehicle to protect your current circumstances, your family, your current self. So it's really interesting. Yeah, I've always found it quite fascinating. And it's just not saying that superannuation shouldn't be able to house and pay for insurances, because in the absence of that, and I understand that it creates a whole heap of issues and considerations, which is what we were just talking about. But in the absence of that, imagine if it didn't, we've already got an underinsurance issue within Australia. But if you take that feature outside of superannuation, all of a sudden you've got a huge problem. I think the system that we've got now caters for that, but being aware of those things, understanding that it is putting pressure on your retirement savings vehicle, coming back to the contribution aspect and needing to put some money towards offsetting that, like you would if you took these policies out of super, you'd need to pay for them. So why not treat it the same way if that's the case? And it doesn't necessarily need to be, dollar for dollar, because there are some concessions in terms of how superannuation's taxed, but at least you're going some way to trying to offset the cost incurred by your superannuation fund as well too. So
yeah.
Andrew, premium deductibility on income protection policies inside super?
Yep. When we talk about deduction or tax deduction on premiums, we're talking about when it's in the superannuation fund, it's the superannuation fund that claims the tax deduction, not you personally on your tax return. So you pay for income protection policies inside of superannuation, you're getting a tax deduction on the premiums that are associated with that income protection. The superannuation tax rate is 15%. If you pay for an income protection policy outside of superannuation, your tax deductibility associated with those premiums is at your marginal rate of tax. So if you're on a 32.5% tax rate or a 37% tax rate and you're paying for income protection policies personally, you're claiming a tax deduction based off that tax rate, as opposed to holding it inside of superannuation where you're claiming a tax deduction on a 15% concessionally taxed superannuation rate. So from an income protection side of things, there's more deductibility associated with funding premiums outside of superannuation for the majority of people.
Yep. Well said. Policy definitions can be more restrictive inside super versus outside, so that's a disadvantage that we need to be mindful of, primarily because the super trustee owns the policy. When you then also consider the auto acceptance policies that we were talking about before too, because people don't go through underwriting when they get automatically accepted insurance with inside super, the policies tend to be of a lesser quality, and this is generally speaking. They underwrite across an entire group as opposed to on the individual themselves. So you're aggregating that risk across the entire group. Just by its very nature, because of that, the policy definition's not as strong. So that's pretty straightforward. But that's something that you need to consider. Life insurance is pretty straightforward. It's black or white. Either you're alive or you're not. So that one there's not a real big difference. There are some intricacies and things like that associated with that. But on mass, life insurance is pretty equal. TPD seems to be the big one where we're seeing significant policy definitions between the policies owned inside super versus outside of super.
Yeah, permanent disability and income protection, there's a fairly large discrepancy. And look, that's not to say that you don't go for a policy that's of a lesser quality. The cost difference is large enough, that covers you sufficiently enough, then by all means, as long as you're making an informed decision and you're doing that based off rationality as opposed to just convenience.
Yeah, it's one of those things. You're absolutely right. I mean, it's one of those things where you're taking all of this together and putting it in the blender and then working out based on a set of hierarchy or, what's important to you, and then working out what the best solution is for you. So it's different for everybody. But making an informed decision, like you said, absolutely the way to go.
Yeah, which I think is the perfect segue of really the things to consider when you're comparing and contrasting policies inside and outside of superannuation is how it fits into your broader strategy. If your strategy is driving wealth towards superannuation, retiring at an age that you can access superannuation, then maybe funding policies inside of super isn't the best manner in which to do it. If your strategy is building wealth outside of superannuation, and yes, I understand that my superannuation is going to be impacted by the result of premiums, but I know that my superannuation is going to get to a sufficient number for retirement, but I don't want to retire at the age of 60. I want to retire at 55. And so I need to, invest as much as I can now in order to fund that period between 55 and 60, then sure, fund the policies inside of superannuation, drive as much of your cash flow as possible towards investments outside of superannuation. Or there's combinations of both, like really putting everything into the blender and seeing how it impacts the broader strategy is ultimately the most important thing when you're deciding on having a policy both inside or outside of superannuation.
So what I'm hearing, Andrew, is essentially get advice.
As always.
The advice, even though this is a general advice podcast, the advice is get advice, right? Yeah. I think we can say that. So potentially increasing the benefit amount to cover any tax applicable.
Yep.
That's obviously another consideration, as is salary sacrificing to cover the impact it's having on your, or concessional contribution for the impact that it's having on your superannuation balance as well. There are probably another couple of things that we need to consider when we're looking at this. Payments inside and outside of super, Andrew?
Yeah, look, there are actually certain insurers that will offer the benefits of both. So partial payment inside super, partial payment outside super. A lot of these policies will also give you the option of, even though it's partially funded from superannuation, the policy definitions of an outside superannuation policy. So there are specific policies that can cater to the needs of both and actually take advantage of the best of both worlds without having to have two separate policies.
Yep. A little bit more complicated strategy. So I'd say that that's probably something. you didn't let me run up to it. And you took the words out of my mouth, but it's a little bit more of a complicated strategy for various reasons. Something like that, you'd need to be under a recommendation of an advisor, I imagine. It wouldn't be something that someone would do directly with an insurance company themselves. Probably the last thing, we've seen some legislative changes and the government have got some initiatives around protecting people's superannuation balances, and they don't want people's superannuation balances being eroded by insurance premiums if they're a lost superannuation account or an inactive superannuation account. So if there haven't been any contributions into a superannuation account for a certain period of time, I think it's 16 months, Andrew, the insurance will get cut off and turned off because the legislation is designed that the super balance does not get eroded by insurance premiums that aren't being used. So where you're housing your insurance, it's always a good idea to have your contributions going into that account so it doesn't get stuck into or get recognised as an inactive superannuation account.
Yeah, and there's a whole bunch of unintended consequences as a result of that. So you consider someone that's gone overseas and is working overseas for a period of time. They've got insurances funded within the superannuation fund, aren't checking, mail as frequently as they probably could be if they were here and working in Australia. All of a sudden, 16 months worth of no contributions can result in those insurances lapsing unintentionally. So making sure that there's an opt-in for all of these insurance policies inside of superannuation. So making sure that you're opting in order to retain cover that you want to keep. Same story. I mean, we have instances where a client has a default level of cover within their existing superannuation fund, can't get insurances or have loadings and exclusions on any new policies. And so the strategy is to retain the existing super fund with the insurances and top up the insurances elsewhere, either outside of superannuation or with a different superannuation fund. Really important to stay on top of it because all of a sudden your super contributions are going to a different fund. You've got smaller balance within the super fund, 16 months worth of no contributions. All of a sudden those policies can lapse. So making sure that you're, again, opting in, keeping an eye out of any possible policy cancellations is really important because kept it there, it's usually there for a reason, provided that there's an intention to keep it there.
A few things to consider when we're looking at insurances inside versus outside super. So hopefully we did it some justice. Andrew, thank you. As always, to our listeners, thank you for your attention. Hopefully you got a whole heap of information out of the podcast today.
Yeah, thanks very much for listening. Billy, thanks again for the podcast. And as always, any additional information, anything further that you want to ask, feel free to reach out to us. Details are in the show notes. And we look forward to jumping on to the next podcast and catching you on the next one.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.